option delta. This is sometimes known as the hedge ratio, and it's better known as the sensitivity of the option price in terms of dollars to a change in the underlying commodity price by $1. So the delta, in a way, is a sensitivity. It tells us, for example, if the delta is 0.75, that if the underlying commodity increases by $1, then the call option will increase by 75 cents. If the delta is 1, it means that there's a 1-for-1 relationship. If the underlying commodity goes up by $1, then the option will also increase by $1. Now, there's a number of reasons that we should be familiar with the delta. It's a very important concept. And what I want to do is to explore two applications. One is an application where we're actually trading in options and we need to use the delta. And the other is a hedging application. So let's first consider the trading application. Now, suppose that we identify an option and we know something about the underlying volatility of the security that the option's written on, and we can actually use the Black-Scholes formula to price the option. Now, given our input of volatility, we determine a price that might be different from the market price. So suppose we do this and we find an option, and this option is trading for, let's say, $5, and we determine with the volatility that we use that the option should only be priced at $4. So this is a situation where the option is overvalued. Now, this is also a situation where we believe that the true volatility of the underlying commodity is less than what the market perceives. If we think the value is 4, given our perception of volatility, and the market believes the price of the option is 5, given its perception of volatility, it's clear that the market has an assessment of volatility that's higher. Remember, the higher the option price, holding all other things equal, the higher the implied volatility. So we have a good estimate of volatility, and we actually want to do something about it in terms of trading. So the question is, what are we going to do? We've got an option out there that is trading at $5 in the market. We believe it's only worth $4. Well, it's obvious that the option is overpriced according to what we believe volatility will be. So one possibility is that we go out and actually sell or write the call option at $5. Now, this is a possible strategy. However, this strategy could get us into serious trouble. Let me tell you why. Suppose that we do this and the underlying stock the next day goes up in value. Well, if it does, we stand to lose in a big way by selling the call. Remember, when you sell a call, you collect the premium, which in this case is $5. But your risk is if the stock price actually goes up. So suppose that we actually initiate this exercise, and the market's perception of implied volatility is 15%, and that delivers the a market price of $5 for the option. And our perception of implied volatility is more like 12%. And that delivers our price of $4. So one thing, as I said, that we could do is we could just sell the option at $5 and hope that the volatility changes from 15 to 12, which is our forecast. Well, if nothing else happens in the market and the volatility changes from 15 to 12, then the price of the option is going to drop to $4. When that occurs, we actually unwind our short position by purchasing. And you can see the mechanics here. If we sold at 5 and then buy back at 4, then we make $1, which is our expected profit. But as I mentioned earlier, we can get into serious trouble with the stock price increasing. So it might be the case that the underlying stock price increases. The value of the option goes up to $10. And it might also be the case that the implied volatility at the same time drops to 12%, which is exactly what our forecast of implied volatility was. However, we stand to lose. We stand to lose because we weren't hedged. The call option goes from 5 to 10. When we unwind our position, we have to go and buy at 10. We take a $5 loss. So, we want to protect ourselves against this scenario. And this is where the delta comes in. So the delta, and another definition of delta other than sensitivity, the delta tells us how many shares of the underlying stock that I need to buy to hedge the sale of one call option. Another way of saying this, it tells us the number of shares I need to sell to hedge the purchase of a call option. So let's go through this in some detail. Suppose that the option delta is 0.5. So this tells us the number of shares that you need to purchase to hedge the sale of one option. Now, what I'm going to do is to exactly follow this example. So suppose that we're in a situation where we sell the option that is worth $5 because we believe the implied volatility is lower. The true implied volatility is lower. And at the same time we sell, at the same time that we sell the option, we purchase 0.5 of a share of the underlying stock. So if we did say 1,000 options, we would buy 500 shares of the underlying stock. Okay, so it's two things that we're doing at the same time. Now let's follow the example, and let's use those numbers: 1,000 options and 500 shares. Suppose it's the case that the scenario occurs that nothing happens to the stock price, but the option is revalued because people realize that our forecast of volatility is exactly the true forecast of volatility. In that case, the next day the option goes from $4 to $5, and we pocket $1. And we've got 1,000 options, so we pocket $1,000 profit.